Hey everybody, hope you all are doing well and welcome back to Michael's Matters. Now, of course, I am Michael, and today we want to talk about one of the biggest questions for folks on Social Security benefits, which is, are my Social Security benefits taxed? Because over this last year, there have been a variety of pandemic benefits that came out that really boosted some of the incomes of folks who are on programs like Social Security Disability SSDI, Supplemental Security Income SSI, Social Security Retirement, as well as Railroad VA retirement benefit? And the answer is, well, it depends. So today we're going to be talking about, in general, when are Social Security benefits taxed and how are they taxed federally. Now, if you like these videos, if you find them interesting, if you find them helpful, or at least if you find them useful, please don't forget to like and subscribe. That way you can get updates when our newest and most informative videos become available. Right now, let's get down to the video. So first, real quick, just a disclaimer. I am not a tax person. I am a person who is taxed, if that counts. But this is not tax advice. It's just kind of a good place for folks who have Social Security benefits and who are wondering how they're taxed. It's a good place for them to start. But if you want specific information about your specific situation, obviously talk to a tax professional. There's lots of them out there, especially this time of year. And you can even get it done for free through the program called VITA, which does taxes for folks who have incomes below $64,000. And they usually have in-person sites at community centers and senior centers and libraries and places like that. So look them up, VITA. All right, so let's start off today's video with a real quick and dirty about how Social Security benefits are taxed at the federal level. And the first one is going to be the easiest one, the easiest situation out of all of these, which is for folks who have Supplemental Security Income or SSI. This is the Social Security program that provides monthly benefits to adults and children who are disabled or are blind and have income or resources below a specific level. Additionally, it is also available for folks who are 65 years or older who don't have disabilities but also have low income and low resources. Now, this one's super duper easy because SSI benefits, well, they're never taxed. So that's SSI, not taxed. Done, right? Where things start to get a bit trickier is for other Social Security programs. So things like Social Security Disability, Social Security Retirement, survivors, as well as spousal benefits. Now, the way the IRS determines whether or not your benefits are taxable and at what rate is based off your overall income or your joint income if you filed married. Depending on your income, you may have as much as 50% or even as high as 85% of your Social Security benefits taxed at the federal level. So let's start with just individuals and then we'll talk a little bit about couples. So for individuals, the income, as you would think, is set at a lower rate than for couples. And that being said, that if you file your taxes as single and have less than $25,000 worth of income, then you're scot-free. You don't pay any taxes on any of your Social Security benefits. But if your income is over $25,000, up to $34,000, then 50% of your Social Security benefits can be taxed. Now, to be clear, it means that 50% of the income is taxed. It doesn't mean that they're taking 50% of your income. If we look at the IRS form RP2021-45, it gives us a hint about how much those taxes will be. It says that if your income as a single person who's never married is over $10,275 per year, but under $41,775, then your tax would be $1,027.50 plus 12% of the excess over $10,275. All right, so what does that look like as an example? Well, let's do one here. So if we go to the trusty old Social Security data, and let's say from the month of December 2022, we can see that the average Social Security check in December 2022 was $1,688.35 a month. And let's assume this person also works part-time and gets paid $500 a month from work. So this means that the total yearly income is $20,260.20 from Social Security, and then also $6,000 from working, or a total of $26,260.20 a year. Now, we know from Social Security beneficiaries, if your income is over $25,000 a year, then 50% of your Social Security benefits are going to be taxed. Also, looking at the IRS website, it shows that the taxable amount for unmarried individuals who have an income over $10,275, they're going to have an income that is taxed at 12% plus a flat tax of $1,027.50 for good measure. That means with Social Security benefits at $20,260.20, well, 50% of that is going to be taxable. So that means that $10,130.10 of Social Security benefits are going to be taxed at a rate of 12%. For Social Security portion, 12% of $10,130.10 is, drumroll, $1,215.61 that would be owed to good old Uncle Sam. Furthermore, for the working income, which is at $6,000 a year, 12% of that comes out to $720, which will be owed to the IRS. Now, combining these comes out to a total of $1,935.61, but we have to add the flat tax of $1,027.50, which means the total, the real total, the amount that goes to the tax man is $2,963.11, which hypothetically, this would mean that this person who is working to get that extra $500 a month, and it puts them over that $25,000 threshold. Well, I mean, that is definitely a situation that they're going to have to consider if it's worth paying the extra tax for the extra hours, the extra money. That, of course, is just the first level. So for individuals who end up making over that $34,000 a year, they are in a situation where they may have to have 85% of their Social Security benefits being taxed, which is a big, big difference. So let's take a look at an example of that. So if we take the same situation with the average Social Security benefits of $1,688.35 a month from December 2022, but now this person is working more hours and they make $1,500 a month. That means monthly they're making $3,188.05 a month, or yearly $38,260.20. In this situation, the Social Security benefits are the same, yearly benefit of $20,260.20, but the working income is going to be at $18,000 a year instead of $6,000 a year. But what has changed is now that they are making over that $34,000 a year threshold, 85% of Social Security benefits are taxed. So at 85% of Social Security benefits, that now comes out to $17,221.17, which is eligible to be taxed at that 12%, which ultimately comes out to a total of $2,066.54 that is owed to the tax man. Then that full $18,000 of working income is taxed at 12%, which means that the tax bill for just that portion of income comes out to $2,160. So you put those two together, $2,066.54 and $2,160, and you get $4,226.54, plus the flat tax of $1,027.50 that everybody pays, with incomes between $10,275 and $41,775 a year, which means you get a total tax bill of $5,254.04, which is a whole heck of a lot more money. And again, this is yet another consideration if you are in a situation where you're getting Social Security benefits and you are working and trying to figure out exactly how much you need to live, how much you need to work, and where that happy medium is. So that's a real tough choice. So that's for individuals, but the same applies for folks who are on Social Security benefits, but who file jointly. And the numbers, of course, are going to be a little bit higher because there's two people. So for married joint filers, if their income is between $32,000 a year and $44,000 a year, then that is when 50% of their Social Security benefits would be eligible to be taxed. Or for the next level up, that'd be anything over that $44,000 a year, then that would cause 85% of a couple's Social Security benefits to be eligible to be taxed. Realistically, looking at how Social Security is taxed and understanding that the future of America cannot really rely on an ever-expanding workforce, aka more babies being born, it seems antiquated and really ill-adapted to put seniors and older Americans and retirees in a situation where they're potentially putting their finances at risk by wanting to work longer or wanting to work more after they already start receiving their Social Security benefits. I mean, just look at those numbers. I know I would be really weighing out whether the extra amount of work is worth the additional benefits versus the cost of the increased tax. I'm not saying it would be a solution to all of our problems, but by removing these types of financial disincentives to not work after you start collecting Social Security benefits, it definitely would help the working population continue to work longer. The other side of this is, which is even more sort of kind of depressing, is that the rising cost of inflation and the housing and food and all these other things are forcing seniors and older Americans to actually have to work longer, which can put them in a situation where they work harder to make more money, basically just to pay the bills and also to pay the taxes, especially once they hit that threshold. So changing the structure could really be another small help that, with a mix of many other solutions, maybe things like a better COLA, more Social Security benefits altogether, will help older Americans and retirees to keep working longer if they want to, and also keep all the benefits that they deserve and were promised when their golden years. All right, so that's it for today's Michael's Matters. And I hope that you enjoyed this video. And if you did, if you found it interesting, if you found it helpful, or if you at least found it useful, please don't forget to like and subscribe. That way you can get updates when our newest and most informative videos become available. So for Michael's Matters, I'm Michael, hoping that you take care of yourself, take care of others, and have a happy, healthy